Hello everyone, and welcome to this Demica webinar titled Demica Insight Q4 2022, Turbulence in the Physical and Financial Supply Chain. Before we get started, I'd like to go over a few housekeeping points so you know how to participate in today's event. Firstly, you're using your computer audio to listen to the webinar, and you're all in listen-only mode. We would, however, really encourage your participation in the session, and we'd love you to submit your questions for the speakers via the question pane of your control panel. You can do that at any point during the webinar, and we will come to those at the end of the session. Finally, the webinar is being recorded, and you can expect to receive a recording of the session within 24 to 48 hours following the webinar. Thanks once again for joining, and I'd now like to hand over to our CEO at Demica, Matt Wreford.
Thanks very much, Dan, for that. So our agenda today is to look back at the data that's come off our platform and to look at a number of subsectors and how they've performed during 2022, in particular during Q4. We'll talk a little bit more about our data and what makes it up. But what we're really interested to see is, what does it tell us looking backwards? And maybe therefore, what insight does it provide us from looking forward? Though to pre-run some of maybe where we're going to be headed, Martin and I were talking before this call, and we're not sure, to be honest, whether we can project forward in this market environment with much certainty. That title about turbulence in the supply chain very much is the topic du jour for us. Clearly, there are very, very significant working capital implications of what's going on in the physical and financial supply chains today. And we'll touch a little bit on that as well. We look forward to your questions, as Dan said, and we'll try and make space for those at the end. Next slide, please. So I'm Matt Wreford, the CEO of Demica. For those of you who don't know me, prior to this, I used to run the holding company above ICAP, the world's largest interdealer broker. And then I joined in about 8 years ago and have been helping transform Demica, taking it from a small technology company into the world's largest supply chain finance platform with over $27 billion of assets outstanding. I have a broad range of experience across the financial services and fintech space, having served on the boards of asset management companies, insurance MGAs, trading, and other financial services businesses. I'd like to invite our guest, Martin Eberle, to join and speak to him and introduce himself. Martin, please.
Thanks, Matt. Thanks for having me, and also welcome from my side. As you might hear, I'm not native English speaker. I'm a Swiss. I am the Chief Financial Officer of Hellmann Worldwide Logistics since about 2 years. I started my career in banking and then worked almost 20 years at Kühne + Nagel. So quite a long journey in the logistics field. Hellmann Worldwide Logistics is a mid-sized forwarding and logistics company based in Germany, 150 years old, still family owned, about 5 billion turnover and 14,000 employees.
I mean, Martin, you have a very interesting background for the purpose of this discussion, right? There can't be that many people that in your role as CFO have both come from the banking sector and then moved into the logistics space. Has that been useful for you in the last few years, your prior life, or is it a totally different world running a large logistics firm?
It is a completely different world, the logistics world. I must say, however, if I look at my team at Hellmann, there's a lot of ex-bankers. So
is that because they want to get out of banking and go do something else, or is it the draw of the global logistics world?
I let everybody draw their own conclusions. But logistics is a very good field to work in.
Brilliant. If we could have our next slide, then. So I mentioned a little bit earlier, Demica put out a press release a few days ago that we've reached $27 billion of assets under administration. That's the value of the receivables that are on our platform at the 31st of December. That's a really big milestone for us. This reflects 28% year-on-year growth. It means that our 8-year average growth rate is still over 30% year-on-year for every year during that period. As you can see in the data here, our business is heavily slanted towards the seller-led program, so receivable finance either discounting or securitization or structured transactions. But we're also very active in the approved payables space, where we have nearly $6.5 billion of programs. The buyer-led programs are growing at over 35% a year. And this reflects broadly what's taking place in the wider market, where we see continued strong demand for suppliers on supply chain programs. While on the seller-led side, what you're seeing there is large companies that previously hadn't used seller-led programs dealing with a rapid inflation in the value of the receivables they're holding, turning on programs to help deal with that problem. We think this level of growth will be sustainable throughout 2023, and probably will accelerate, if anything, based on the forward order book. So the market is in very good health, and we're very pleased, and thanks to all of our customers that are on this call for helping drive that growth. Dan? So just moving a little bit into the data. To create the Demica Insight dataset, at the start of 2020, we segregated out 1,200 companies out of our dataset who continuously or very regularly transact with their customers, and so that we're receiving either daily or near daily invoice levels from these 1,200 companies, because as you know, their ERPs are connected into our platform, and therefore from that we can then create a composite anonymized index set to then see what's going on in particular sectors. So some of the companies in here will be doing seller-led programs, where they're, say, in the computer electronics space, and they're selling up into distribution channels, etc. And equally, they could become electronic companies that are on the supply chain programs of other firms, say the automotive sector. So we always track to the sector code of the supplier. And you can see in this mix, in the data set that we're tracking, a broad range of different sectors. It doesn't totally represent the activity at Demica, because obviously it moves around and has moved on a long way since January 2020, but we keep the data set consistent to ensure that the insight data that you're about to see, it can be followed from the start of January 2020 all the way through to today. So we don't really bother to publish the total, because it's really an amalgamation of too many things. But we're going to touch on just a few sectors in a moment to give people an insight of what is going on in the market today. And again. So this particular slide shows you the volumes across the computer and electronic space. That is a broad range sector, so that would include not only things like laptops and personal electronics, but also electronics for, say, the automotive sector or industrial sectors. And you can see in the green, you got the 2020 data, the light blue 2021, and the darker blue in 2022. And there's been quite a significant drop-off in volumes during the last 6 months. Martin, over to you. What were your observations when you saw this data?
I think it coincides quite with our observations. If you look at most of this, or a lot of this stuff is shipped by air, and we have, the global air freight in the second half of the year until November for high tech has dropped by about 4 or 5%. So I think this we've seen throughout the COVID and the after COVID area very high volumes in the high tech, but we've seen that slowing down. One thing we hear from our customers is also inventory levels that have built up, especially in Europe and Americas, which then has reduced shipment levels on our side.
So that's interesting. It's public knowledge that one of Demica's clients is Lenovo, and they suffered very significant supply chain disruption during the start of the Ukraine war in March 2022. And I was chatting to Wai Ming Wong, the CFO there, about why it was having such an impact, because it wasn't obvious to me why Lenovo manufacturing predominantly in China was being disrupted by what was going on in Ukraine. And he actually pointed out that at that point in time, the vast majority of their laptops for Europe were actually running by rail through Russia and into Eastern Europe. Is that fairly common in your experience, that people are using rail links to ship goods from China through?
Yeah, I mean, it has picked up because it's considerably faster than sea freight, especially when the sea freight. Remember, at that time you had all the congestions at the ports. It was actually very difficult to get space on a ship. Air freight capacity was also low, and prices were very high. So the rail link actually worked very well, we've seen also this, because you have to get to Russia. When the war started, there were ideas that you could go a southern route over the Caspian Sea, but then you would have to transship and get the wagon on a barge. And that, of course, you would never have the same capacity as if you could run straight through Russia. We have quite a big rail operations, and a lot of our customers were very hesitant in the early days to still ship through Russia, but the rail link is up again, more or less, and customers feel more and more confident to ship that way again.
So that's really interesting.
And don't forget, when the war started, especially if you had to fly from China to Europe, you didn't have the north route anymore over Russia. That, of course, made also transit times longer. It made the cost higher, etc. So it was difficult in the beginning.
So I have a couple of, thinking what you just said, a couple of sort of thoughts. The longer transit routes you see in the data set on our working capital finance areas here, because the DSO increased materially in these contracts, right? So the amount of receivables that had to be financed increased significantly. At the same time, there was quite a lot of physical supply chain disruption in manufacturing in these sectors. And so what you can see, particularly in, say, June 22, that very strong spike in outstandings is basically volumes being delayed slightly in April and May, hitting the end of the quarter, and then being shipped by sea or on longer journeys, right? So it was a real double or triple whammy for those in this sector in China during that period of time.
But do you think the quarter peaks also have to do that companies want to recognize the revenue? It seems to always fall. It always seems to fall at the quarter end.
This sector has always an extremely strong quarter end seasonality. I think it's probably less about recognition of revenue by the manufacturers or the OEMs as much as it is by the customers looking to meet sales quotas, because they're selling into distributors like Tech Data, Ingram Micro, right, that are running on a very strong quarterly cycle themselves. But you can see it's very pronounced in every quarter throughout this 3-year period. But if you look at the December 22 data, right, it's now for the first time below December 2020, right? And that is this the final end of that pandemic push, right? To your point, there was a surge in demand, then a rise in inventory that kept manufacturing levels up. Onto that look forward question that we started with, you know, one has to be thoughtful, right?
Absolutely. I think it's quite right that the first half in production and so on, and also logistics, the outlook was maybe a bit too optimistic, and their inventory levels have built up, and that probably has then also contributed to a slowdown on the production side.
So I think watch this space on this one. Dan, do you want to move us on to the next sector? So this is paper and packaging. It's a deliberately quite a broad sector aggregation, but in the fact that it would include both the actual manufacture of paper, the conversion of it into cardboard, and then cardboard packaging itself, as well as glass and metal packaging such as aluminium drinks cans, etc. We've deliberately put it at this higher SIC code level because otherwise it starts to identify some of the large customers that are in the mix. We find this chart quite interesting, because if you look at 2020, the start of the pandemic, the volumes were quite stable. And it wasn't really until 21 that we started to see this very, very strong growth in the value of the receivables. And don't forget, when we talk about volume, we're talking about invoice value, because within that, of course, there's unit price and the number of units. And that continued to grow very strongly through the first half of 2022, as you can see. And then since then, there's been quite a marked decline. We're talking about a peak sort of in the 165, 167 level, down to less than 130 now. So I have some thoughts around what's going on in that. I don't know, Martin, whether you would like to start with your thinking around the sector, though I know it's an area you guys are less exposed to from what you've told me before.
Yeah, we're not very exposed to that, as meaning that we don't have many customers in that area, but obviously we also use packing materials and etc. I think what struck me is this downward trends in Q4, because generally, at least in freight, we would expect a peak season somewhere in Q4, be it in sea freight and in air freight and road transportation as well, and that simply hasn't happened this year. We started thinking it might maybe be a bit less of a peak, but then coming closer and closer towards the end of Q4, we just realized, and it's not just us, it's a market. The market, especially out of Asia, the peak didn't happen.
And that really doesn't bode well on the look forward, right? Because if you think about the packaging, this all ought to be being sold into the pre-Christmas manufacturing cycle, right? So
sure.
if you look at that 21 data, it was remaining strong all the way through to early November. In fact, if you look at it on a week-by-week basis, you can't see it in these charts. And it's only obviously the slowdown comes later in December. The drop-off also in 22 from November to December is much greater on a percentage level. And so if this is a precursor to effectively, again, probably too much inventory potentially building up in the channel and flowing through. And it certainly makes me pause for thought, right? If we think about some of the really good, the pieces of data that are useful from our data set for having a view of general economic performance, this is one of them, because obviously the packaging is used across a broad range of different supply chains. And then obviously our logistics data set in many ways is probably the most important, right, Martin, because you operate across such a wide level of different sectors.
Yeah, I mean, if you look at this chart, it is scary, because it would point at a continuation of that trend. I could just say from our experience now, we had a very, if just look at volumes, it was a very disappointing October, very disappointing November. We didn't see it come that way. I've seen DSV published today, so they're public, so they also didn't seem to have a too strong volume quarter. But December was surprisingly strong. By strong, I don't mean as strong as we hoped it would be, but the negative trend we've seen sort of coming in August, September has sort of stopped. Whether there is now a glitch, and it was just because we had a few customers that shipped more, or I cannot judge yet. Bookings for January are lower than they were 21 and 22, but it seems to, our experience at least, maybe that's just our customer mix, seems to stabilize somewhat.
How many customers do you have, Martin? What's the makeup of your data?
We have about, I would have said, between 10,000 customers, but a lot of them are rather small customers. If I would look at our top 50 customers, they would probably make up half of the volume. So it is our data is a bit tilted towards larger customers, and there we have certain industries which are relatively strong. High tech is one of them, but we are also quite strong, for example, in fashion, which had also very, very extreme cycles in the last 1.5 years.
Yeah, we don't bother to publish our apparel data. It's incredibly volatile. And we were wondering whether or not, we'd assumed, by the way, that was meant that our data wasn't representative, right? As in it was just switching the different channels and things. But it's interesting what you just said, that you're saying that it potentially is a very volatile sector.
It had extreme swings. I mean, it was one of the highly affected industries, obviously, at the beginning of the pandemic. And with the e-commerce boom setting in, they could sort of mitigate that and came back a little bit, at least on our side. But then they were very affected last year by the congestions in sea freight, because other than high tech, most of this moves by sea freight. And actually, they contributed a lot that air freight volumes were last year so high, because eventually they had to fly a lot of things that you wouldn't fly, because last year the Christmas push was much higher. And then this year they had inventory. I mean, there are a few cases which are documented where also certain companies were too late in realizing that in 2022 people change their habits and they have enough of Corona stay-at-home clothes and maybe want to have something different. So we've seen inventory levels go up dramatically, and then shipping in the second half was low. And don't forget, also a lot of these brands also had exposure in Russia, and have pulled out.
Okay, so you're probably grateful then to be CFO of a logistics business, not an apparel company then at the moment.
We all have different challenges, I guess. Sometimes you're up, sometimes you're down. So
that's true. You've had your own volatility to deal with, as we'll get to when we get to talking about.
We had a lot of volatility indeed.
Let's move on, Dan, to talk about our next sector here. So this is food production, and in particular, this is the combination of two subsectors in our data set. The first is the production of food, so not raw material like grain or rice or wheat, etc., but the manufacturing of anything from flour through to bread, if we take the same products for a moment. As well as, in fact, wholesale catering can come into this. So not restaurants and things, but then it's a very large catering businesses. And it's quite a diverse set of customers within it. To me, we don't normally put a trend level in our data sets. Normally it's we're looking at seasonality, etc. But I've added one in for the 2022 data there, that red dotted line, because it just gives a sense of what's happening in food inflation, right? I think that's very much the topic here. And it by no means seems to be stopping, right? Yes, there's some peaks and troughs around July and August, but there's a very strong continuous trend that it starts, you can see, in fact, back in 21, it was already beginning to kick off, and then has continued through in 22, which basically suggests to me that anchoring it entirely back into what's happening in Ukraine is a little bit too simplistic, right? There's been inflation running in the sector for a while. It's just picked up really quite significantly in the last 9 months. Martin, is this an area that you guys touch on much?
We have quite a bit of business what we call in the perishables area. So there you're always exposed to seasonality, weather and things like this, and you usually have quite big shippers. I would say if your conclusion here is it's mainly inflation driven and not volume driven, then I would say on the whole we had similar volumes 2022 as we had in the previous year. So I would tend to agree there's probably rather a price inflation than higher volumes, at least from the data that we see.
Yeah, I think that's obviously a key point, right? In our data set, because we're looking at invoice value, right, we have to be thoughtful to that separation of the unit number versus unit price. Any guesses as to what might have been going on in July and August? I've been thinking about that since we extracted the data and haven't really come up with anything obvious other than maybe an artifact. of time.
I hope I could ask you whether you have any insight, because I have no clue. I must say I'm clueless. I would imagine it's an outliner, but I wouldn't have any more educated guess.
Yeah, no, we to actually really true the answer, we'd have to, of course, de-anonymize the data and then get into which company and what was going on around month end, which is something we don't do. But yeah, I was looking at it thinking, Jesus, that's a hell of a whipsaw that took place in the middle, particularly in a sector that's normally quite stable.
So I'm not sure whether we have lost Matt.
I think we've briefly lost Matt. His connection has given out on him. Martin, maybe I will press ahead into the next section, which is your section anyway, because it's focused on your industry. And while we wait for Matt to hopefully reconnect, I can tee up this data, which is firstly the same insight, a slide on the same insight data we've been seeing, and rather than pertain to have any insights at the level of Matt, I'll maybe just ask you to comment on what you saw in this data and how closely it reflects some of your experiences at the moment.
Yes, I mean it clearly shows. I think it's not just volumes here. It's obviously a big price element in it. I think it has made all the headlines so that freight rates have gone up, and if you take, for example, freight rates from Asia to Europe, North Continent, a container would cost you under normal circumstances $2,000, and have gone up to $15,000, and is now back to something like $2,000. I think this is what we also see here. Revenue of the transport and logistics companies, especially those exposed to sea and air freight, has gone up dramatically. And I think what we also see, the flattening of the curve. I'm explaining your data, Matt.
Thank you very much. Apologies, I just lost connection here from New York.
I was just talking about freight rates and have they gone up and down, and I think we could see that if you look at the 21 and particularly the first half of the 2022 graph, that it has been elevated quite substantially over 2020, and if you would put the pre-COVID, it would probably be even slightly lower in 2020. But that we also see that it comes down now. I think that is the second half, where costs are still up, I would say, is in road transportation, where we've just seen prices continue to increase. I think capacity there is a different topic than sea and air freight, where you see a lot of capacity coming in. Sea freight, you see full order books by the major shipping lines, or by most of the major shipping lines. And in air freight, you have the traveling that is coming back, that brings also cargo capacity. And then in the supply chain crunch that we had end of 21 and beginning of 2022, a lot of people have ordered new airplanes, new cargo planes. So there's a lot of capacity coming in. And as we see it, you have seen it in high tech. The volumes are not there at the moment.
And I mean, this data set's quite skewed to road logistics over sea, just from the nature of our customer base. And you said to me something on the pre-call that that really struck me, because I'd been saying that I'd understood that road logistics rates were elevated because of the price of diesel, which has gone from sort of 30 to 50% of the actual cost of road logistics. But you mentioned to me that there's a driver shortage still. I mean, is that something that's in Europe?
I think that is continuing, and it will not get better. I have no hope that it's getting better. I mean, it got worse partly because a lot of drivers driving through Europe were Ukrainians. They are not driving anymore, and you see a lot of now the older drivers are I mean, these are the years with high birth rates, and you see still a lot of drivers going into retirement, and it is for young people not such an attractive job, because you're always on the road and you're never at home and there are long hours. We as a company, our driver population on average is one of the oldest if you compare it to any other population we have in the company. So I do not feel that this is easing anytime soon.
And in your business, are you employing all the drivers that you're using, or are you also using contractors? Are you all competing as an industry for the same pool of people?
We have both. We have an own fleet, and which is driven by our own drivers, and we outsource also to other companies. But basically, it's the same problem. If we don't find drivers, they also don't find drivers. So and it's I think I read a statistic in 2022 that every second open position cannot be filled at the moment. So it is. Wow. It is a real problem, and it is continuing. So,
and what is the industry doing? What's the industry doing about it?
I mean, the first thing is that we're trying to make it an attractive job. I mean, you see in certain specialty business where the quality of the driver is the defining factor. You see salaries paid to drivers now that are really, really high. That will be one thing, so that the job will get more expensive. And the second thing is immigration. We will have to bring people in to drive. Because if you look at the years that come into the workforce, say 2000 or 95 to 2005, there's much less people in these first years than say the ones who go out, like 1960 to 1963, something in that area. So we will have to attract new talent, and maybe we have to also bring in this talent from other countries.
That'll be popular in certain parts of Europe. So
yeah, but it is the only option. I know that I'm not making myself very popular with that, but it's not just for drivers. I mean, we had extreme difficulties in the logistics field to fill positions, not just blue collar and drivers, also white collar people with sufficient experience in the logistics field that actually we could transact what our customers wanted us to transact. And it was not us, it was the whole industry. I mean, every company tried to attract talent from other companies, so at the end it's a zero-sum game.
Yeah.
And I think this will continue. And yes, we have to make logistics more attractive for people to work in, but the work needs also to be done by people, and we need to have enough people. What the thing we do, of course, Corona has helped us a lot with that digital work has become acceptable in a larger sense, and that of course then allows us also to outsource certain tasks to different countries.
So one thing, I don't know whether you talked about it before while I was dropped off, but the volatility in freight rates, both from a marine or sea perspective and a land perspective, has been extraordinary over the last sort of 18 months. And the theme of this sort of webinar is really that interconnection between the physical supply chain and the financial. I'd be really interested to hear your perspective of how the change in pricing has impacted your customers' behavior and how it flows through to, you know, order volumes and an approach for contracting, etc.
I think to say it was extraordinary is probably not an understatement. It was unprecedented. I've never seen anything. As I think you can go back many years that has never happened. This I mean, as I said before, on the Asia-Europe trade lane in sea freight, we went from 2,000 to 15,000 and back. We went up within 12 months. We went down within 4. So this is extraordinary, unprecedented. I would call it. I think it has at least given the logistics a certain prominence, because it was just always assumed that things are where they're supposed to be, and people realize no, there's a whole machine behind it that actually brings the goods to the place they should be consumed. I think that was the one thing. I think also that companies started thinking more about the supply chain, and whether putting all the eggs in one basket is a very clever strategy or not. I think that will have a lasting effect on how companies source in future. Yeah, and I think
we're also seeing, you can see in our data around DSO, right, the contractual terms between the logistics company and their end customer, some very significant changes in contractual DSO, which basically in some respects show what is the relative balance of power between the logistics firm and its customer. I suspect from what you've told me before that there was probably a period of 12 months where you held all the cards in commercial negotiation. Is that a fair observation?
Absolutely, an absolute seller's market. Who could organize capacity at any cost, didn't matter, had it sold. It was not difficult to sell because it was a complete seller's market. And as we said before, if somebody came and wanted to contract with you and said, I pay you in 90 days, you said, find somebody else.
Yeah.
It has shifted dramatically again with the fall of the rates. It's now a buyer's market again. In this seller market, a lot of people try to negotiate long deals and long commitments, but the rates have fallen so sharply and so brutally in a way that a lot of these contracts are currently renegotiated, and we see now tenders coming in 90 days, 120 days, in certain cases even, and I called it before, unethically 180 days. You know, for a freight brokerage company, I don't know where I don't want to finance the freight of my customer for half a year. My margins are not there to do that.
And you would say, and I mean, I agree with you, by the way, payment terms of 180 days in most supply chains are effectively reflecting an overly abusive buyer-supplier relationship, right? Because effectively the buyer is passing through its own financing into its supply chain. We're seeing a pretty significant pickup in approved payables activity in the sector. As a supplier in the space, do you see that too?
Yes, we see that. We see in a lot of tenders that are currently going out, we see that extremely long payment terms are requested in exchange for some sort of reverse factoring supply chain finance program, which is, on one hand, I like it because I can put a price tag to what it costs me to do that. On the other hand, I say just from daily operation, because if I have 50 customers who do it, and maybe through 50 different portals with 50 different banks, just my daily accounts receivable task becomes so complicated that actually my local CFOs and my receivable guys say, we don't want it. It's too difficult. It's too much work. Yeah. So if it would also be your platform, we would be happy.
You are a good friend, sir. And I think, but this is an issue across our sector, right? An increasing number of platforms, and for suppliers that are working particularly geographically across a broad geography, right? So they're not. If you're working in one country, you're probably only going to be on one or two platforms because it's very much a concentrated banking situation in each country, right? In the UK, nearly all the supply chain finance that is done here, it will be done by HSBC and Lloyds, right? The other two domestic banks are much smaller. And so the issue, I mean, it's a particular issue, I think, in your sector, right? Because you will have customers in many, many different countries and exposed to many different platforms. The other thing that we've talked about is the fact that your sector is awash with cash, right? I mean, we see this with the container shipping companies who have put in place enormous securitizations to fund their receivables and are barely drawing on them at the moment because they don't need the liquidity. So presumably, equally, you're not hugely interested in joining a supply chain finance program, given the amount of liquidity you must have at the moment.
I mean, one has to say that the steamship lines obviously took the biggest share of the cash because it cost them, say, $2,500 to operate the box from China to Germany, say. And when you get 15,000 for that same box as a revenue, of course, that goes more or less straight to your cash. We also that all the freight forwarders, that some freight forwarders also made good margins. That's also no secret. So it wasn't a bad time for us, but we made the money because we had capacity and we could sort out certain things for our customers. So, for example, our productivity fell by 30–40% because it was so difficult to find space for the cargo of our customers. So we did a lot of work. I mean, yes, there is windfall profits and it's very nice, but on our side, this was with a lot of work involved. And yeah, the spills for us were good, but not quite as high as the steamship lines. Would we join a program like this? I think for us, ease of use would always be a key factor.
Yeah, no, I can see that, right? Particularly to your point about how many that you're being pulled upon.
I mean, just think about it. We are in 60 countries. We have customers in 60 countries. There's so many. We have then also big customers who pay us in. We just had recently a case that they have one program in Australia, they have a different one in Thailand. That's just one customer already having two programs. This is such a nightmare to administer.
And we see one of the responses to this from CFOs in your sector is actually to pull back from the approved payable programs of their customers and instead securitize or otherwise finance the receivables themselves through a seller-led structure, and which, while it may be slightly more expensive, the administration of it is obviously far simpler because it's coming entirely from themselves. So it's possible that these products, which are quite complementary, as one is picked up to such a degree, it'll now switch back to the more traditional seller-led structures.
I think especially if your debt capacity and your rating allows you, because I remember I was treasurer at Kuehne + Nagel when this program started, and the big catch was always that your own rating was better than your suppliers, and that was the arbitrage you did. But I think given also how the playing field looks today, there are a lot of companies in this supply chain that all have somewhat investment grade ratings, so that whole arbitrage is not really there, except say if we offer that for our trucking suppliers that maybe have 2, 3, 4 trucks, different story. But I think for the big suppliers and customers, they are generally somewhat investment grade.
And that gets back to, this is a sector, I mean, that has gone through enormous change over the last 7 to 10 years. That wasn't the case, was it? Sort of 10 years ago.
I mean, you see that a lot of our competitors have grown by merging. You see this in the shipping lines, with the alliances, you see this with the airlines, you see this with the freight forwarders. Absolutely has gotten bigger. I think also what contributes to that is obviously legislation in Europe and other places, which requires so much more in terms of compliance, human rights, etc., that you as a company actually do not want to, as a customer, you don't want to deal with, say, a local freight forwarder in Vietnam, because you have so high governance obligations and compliance obligations, even as a director, that you want on the other side somebody who, if something goes wrong, you actually have somebody you can go to, and is not a small company that just closes shop.
And that suggests that in which case consolidation is going to continue. But in one area, of course, the trend is against that. You touched upon alliances a moment ago, right? The major alliance between MSC and Maersk has now been announced that it's going to be wound up in a few years' time. What's the key driver behind that, and what's the implication in your mind for the logistics market more broadly?
I mean, I can also just have educated guesses. I don't know exactly what led to them, but nobody in the industry was very surprised. I think also the strategy of these two companies were somewhat different. Also now in this, say, gold rush times, where Maersk always said that they want to vertically integrate and also go into forwarding and logistics and all the rest of it to offer a end-to-end supply chain for their customers, whereas MSC was much less on that strategy. And now we invest in ships, much more than Maersk did. So I think MSC has also overtook Maersk as the biggest shipping line. So I think I'm not quite sure whether they were strategically aligned to that it made sense for both to continue, but there are probably different speakers who could talk more intelligently about that.
Indeed, we have obviously customers in that sector, but they're not very inclined to talk about it for rather obvious reasons.
I kind of,
or at least talk about it publicly, I guess, is probably a better way of putting it. You touched upon previously an observation around the rate of the ship ordering, right? There's a lot of capacity that's going to be coming into the market on the marine side. Is that going to be back to the bad old days of that huge cyclicality that this market's seen? Is there now just going to be a glut of supply for a long period?
I would imagine. Huh? I mean, I can also only just look at the order books and how full they are and what comes in to the market. If volumes don't increase dramatically, I think low margins are here to stay. I mean, the shipping lines try to manage that a little bit by blanking sailings, but essentially that is just a short-term measure. The fact is, new ships will come in, but I think that's also, say, maybe the scrapping rate will also go up, because of course the new ships are more efficient, they are more ecologically suitable, so maybe that improves the rate of the green transformation of steamship lines.
I think there's still a long way for that though to go, given the degree of pollution that comes from them. We've had an interesting question on the channel, which is saying the data seems to be pointing to a recession. Are we seeing a deterioration in credit quality? Well, it's quite a nice segue to the next and final slide, Dan. For those of you, what you're looking at here, we don't always publish data like this, is the blue line is the trailing 3-month default ratio, and the light blue line is the trailing 3-month delinquency ratio. So receivables are deemed to be delinquent in the huge pools of receivables we measure and monitor when they go 60 to 90 days past due, and when they go 91 days past due, they're deemed to be defaulted. Whether the customer has actually written it off or not, our platform will deem it so. And so what you're seeing here is a very, very stable default ratio of around 1% of credit of invoices not being paid or deemed to be defaulted, with a potential sort of gradual increase. And I'll be asking Martin's views on this since November 21, but not going up to maybe 1.5%. But when we look at the delinquency ratio, we see a very different picture. Huge volatility, and we're seeing delinquency levels go, to pretty much unheard of levels in our portfolio as a whole. The logistics sector is almost unique with 8% delinquency at that period of time during mid-22. Martin, what's your perspective on it? Is this the sign of significant credit stress in your customer, or not your customer, the industry's customer base, or is something else going on here?
I don't know what exactly your customer base is, but I think what is obvious that the delinquency rate goes up or went up when the rates were so high, because you generally look at, say, an average DSO in the industry between 45 and 55 days, whereas you have probably payment terms with shipping lines of 30 days. So you have to finance part of that. And I could imagine that when you go up from financing a 2,000 rate on a container to a 15,000, I could imagine that some companies came under considerable stress. That's one explanation I could have. The other one I was thinking is this was also the peak when everybody was looking for good stuff. So it was very difficult, as I said, that industry-wide productivity fell, industry-wide a lot of open positions. Maybe it's a mix between higher freight rates and therefore higher financing requirement that you have, and on the other hand, simply the ability for the companies to properly run their administration because of staff shortage. I would imagine that would be my two.
In terms of the data set, by the way, our logistics data book is probably the largest and most granular pool that we run. There's about 250,000 debtors in this statistic base, because we're running the receivable finance programs of a number of the very, very large logistics firms. I agree with your observation about that correlation between delinquency between the freight rate and that delay, right? So whether it's financing downstream into below or for the customer to yourselves and others, it's clearly was becoming a big issue. There's another aspect that I think we've also been seeing, which is that contractual DSO shortened very significantly during this period of time. This dynamic between buyer and supplier, where all the power was with the supplier. We can see that suppliers in this space demanded much shorter payment terms as the rates were rising. And I have a wonder whether or not clients agreed to it, but were unable to meet it. And therefore effectively they paid when they were going to pay anyway, just slightly late relative to contract.
That might also be. And if you had a big sea freight exposure here, usually the invoices that are paid last, because they're often disputed, are demurrage invoices. So if the container stays at the port for too long, and of course with all the congestions that there were, it could be that we had, like every other forwarder, a lot of discussions with the customer because they couldn't get the container out of the port because of congestion, and still they had to pay sort of a penalty for leaving the container too long in the port. And of course, no customer is overly happy with that, understandably.
Totally.
It could be that could play a role. But I think that it has normalized. I mean, we've seen in our customer base a slight normalization in total of overdue invoices.
Okay, so that's interesting. It's settling back, which to some extent you're seeing it's still got a little way to go, because 4%, if we look at our data set back pre-2020, that would be a little bit more at the normal end.
Right.
Dan, a question for you. We're coming up towards the hour. Are there any other questions other than the one that we had on credit quality?
No further questions at the moment. If the audience has any, please do submit them. But otherwise, I'll leave with you, Matt, to close off with some final questions of your own.
Okay. Well, Martin, first of all, thank you for joining us. I think having your expertise and experience on this call has been very valuable to our audience. As you know, we have a mixture of both industry professionals as well as financiers and bankers on this call. And the bridging of the physical and financial supply chain, I think, is probably one of the most important topics of what is going on at the moment. So I really appreciate your insight. I know you're off on vacation shortly, so I'm reluctant to hold you any longer from it. If there are any final remarks from you, we'd be interested. Otherwise, we'll wrap the call up at this point.
Well, thank you very much, Matt, for having me. It was a pleasure. As always, talking to you is very easy and easygoing, and I enjoyed this hour. And as you rightly said, I will switch off my computer now and go on holidays.
Brilliant. Well, enjoy your vacation. No doubt we'll speak when you're back. Thanks very much, Martin. And thank you, everybody, for joining us.